But more importantly, we're going to be breaking down why we got into this trade, how we got into this trade, and how we got out of this trade. And so without further ado, I'm going to jump straight into the video. But before that, I want to make two very powerful announcements. Announcement number one, back by popular demand, we are launching a group coaching program, which is a live virtual training program with two of our trading mentors, myself included. It's going to be, all the details are going to be available down below. But if you're interested in being taught directly one-to-one with us guys, then you need to go and check the description box. Number two, 50 free trials into our exclusive premium community of traders managed by trading mentors. 50 free spaces for 1 month have now opened up. The last time we did this, which was on the last video a week ago, we had hundreds and hundreds of applications. We have opened another 50. So enjoy the free trial if it's available. If it's not, join the waitlist and you will get perks of being on that waitlist. So let's get straight into the price action. Now, starting on the 4-hour time frame, because we need a foundation, a higher time frame to build our narrative, because a higher time frame is essentially what's going to give us the clarification of where price is going and why. So if we can just zoom out for a moment, we'll see that UJ was very bullish for a long time until this happened. Because internally, this right here is the low that put in this high. So if we just mark out the highs and lows, we can see we have a low, a high, a higher low, higher high, higher low, higher high, higher low, higher high, lower low. This low is lower than this low, which means we were once going up and now we're going down. Very simple to understand. It's just market structure. Now, we want to mark out our point of interest. This is going to be the place where we are going to be looking to take trades from. We're going to be marking out the supply zone that caused the break of structure, which is literally this zone right here. And inside of that zone, what are we going to be waiting for? Lower time frame confirmation. Because you can see, guys, as price makes its way back up to this zone, when I drop down to the 15-minute time frame, it's going to appear to be very bullish. As you can now clearly see, price is emerging bullish. And so we need to see a shift. We need to see a change of character. So if we just look, we can see that low, high, higher low, higher high, higher low, higher high, higher low, higher high, inducement, right? Because we only broke with a wick, which is just a sweep of liquidity. So this adds more liquidity, but again, not an area we can get involved in. Why? Because it's not inside of our point of interest yet. And then this low goes ahead and makes a higher high, which puts in a higher low, which, as you can see, the liquidation above puts in a higher high. So once this low goes, that would be your indication that the 15-minute time frame has shifted bearish. So we have a 4-hour time frame bearish, and then inside of that, the 15 minutes bullish until it gets here, and then it shifts. And so what can we expect? We can expect now the 15-minute to follow along with the higher time frame. And that's exactly the schematic that we're playing. And we play the same schematic time and time and time again. So just essentially waiting for that to play out now, being patient enough to allow it to play out. And you can see now the lows have been taken out. That is our change of character. Change of character, right? Because essentially this is the last point of demand that came into the market that's been overridden by supply, which means there's more sellers than there are buyers, which simply means the price is going down. We just mark out our supply zone, and from our supply zone, that is essentially where our trade is gonna be taken from. And so you'd want to put your entry here, your stop loss just above the zone, and essentially you can assess where you can take profits after the low has been put in. And then again, if you want to go one step further, you can wait for price to get into this zone and drop down to a lower time frame once again to get a much higher reward, but also higher risk and a higher chance of it not executing also. So we'll assess that when we get there, but you can see prices moving up now. So I would be taking partial profits off at this low because it's just structure, right? We're just expecting break of structure down, in, out, in, out. And so because we're expecting this low to go, well, why not take profits as it goes, right? And taking just a portion of the position off is fundamentally valuable. You know, if you're trading a $100,000 account, 1% risk, that is $5,260. It's not bad for a day's work. So just waiting for price to essentially come and give us the tap in, which happens here. Then again, fundamentally, you could drop down to a 1 minute, 2 minute, 3 minute time frame and look to get back involved with a change of character. So how could we do that? Well, if you look, you'll see that this is our demand zone that put in the high. When that gets broken, like it has done, then there is our supply, and you could put an entry on here. That is our more advanced sequence. That's essentially the content that we go over in our course concepts. It's the more advanced trading concepts, but it produces a higher risk reward because you see how that trades a 5.2R. When you put the lower time frame trade on, that becomes a 7.3R, and sometimes a lot smaller. If it was, for example, just taken off the supply zone, it'd be 11R, but I like to cover the highs just to be safe. But that's if you were to take a lower time frame. Now, the pro with this is sometimes you get a much higher risk reward. However, sometimes you don't actually get tagged into the trade, and that's a con. But you can see in this case you do. And so you can see also how it just wicks the high. So it creates equal highs here. That's usually why I have my stops just above the high, just because sometimes it can just sweep the zone and come into here or here. So having it just above the high is important. So you can see that's the more advanced technique and strategy. This is the more open and lower risk, but also lower reward. And so we only teach this to our advanced traders in our course concepts. But you can see, guys, we smashed through take profits instantly. Why? Because the banks are moving the market exactly how we expected it to go. Why? Because we're just positioned where they're positioned. That's all we have to do. We have to understand where are the banks positioning and then position ourselves in alignment with those banks. And you can see price runs deep, like price just continues. That ends up peaking out at 25R. This ends up peaking out at 16R. Granted, there's not really a place where I can say like, look, that's where you should have your take profit in this trade scenario, because it's kind of all over the place, because really and truly, you would be looking long term to take your profits off down there, which is 101R, and that's a 66R. The probability of that playing out is not exactly the highest, but it's possible, and that's the only real place that we could end up taking those profits. And so just playing price to the live position of where we are right now, you can see we come back up, and this is literally where we are right now in live price action, because these are trades that we take. And so you can see as price melts off, we're still in this position. You can see how price has come perfectly back into this supply zone that caused it, which would have warranted another entry. Now, I didn't take this trade because it's a Friday right now. And so the likelihood is that, markets close over the weekend. I don't want to be holding positions over the weekend because I'm already in these two. But yeah, you can just see fundamentally how supply and demand works partnered with these concepts. And you can see as well, all of this liquidity now built up